This is Ken Williams. I'm a brokerage director at BGA Insurance, and today's video is addressing another one of the most common and loudest IUL objections. I don't trust the insurance carriers. They have a history of dropping caps and par rates. In my last video, I addressed the fees within an IUL. This objection, which I hear often, I also completely understand. But with some education and real life experience, which I'll share, this is another objection that I believe is easy to address and overcome. So what has happened in the last 20 years that IULs have been around? We all know that the stock market, especially those in the large cap sector, have done extremely well. It's also suggested that there is at times an inverse relationship between stocks and bonds. As you can see in the last 10 years or so, that bond markets have not done so well. This is important in that retirement demographic, typical rule of 100 stuff. Take some money out of the market, move towards bonds, etc. We also were in an environment where interest rates dropped significantly over 20 years and started to tick back up in 2021. So again, the objection is that advisors don't trust or understand IUL, they've underperformed, etc. If you've watched my last videos, the first question you always have to ask when handling an IUL objection is, in comparison to what and under what assumptions? Now, I speak to advisors from all over. Again, with IUL objections, it's in comparison to what and under what assumptions. Let's take a look at some of the market landscapes. Let's look at commentary from one of the most well-respected and trusted companies in the world, Northwestern Mutual, and these are directly from their annual reports. In 2008, record revenue, $16.2 billion. 2014 set new records across the board with $26.7 billion in revenue. 2019 and 2021, all-time high record revenue of $34 billion. Then they had their highest record dividend payout ever in 2021. Why do I bring this up? It could be my misunderstanding, but I believe this conception holds true for many of you out there. In regards to participating whole life insurance, isn't a dividend a return of a portion of the insurance company's surplus or profit to the policyholders? If that's the case, with all of these record and historic years, mutual company dividends must have increased tremendously to their policyholders, correct? Let's take a look. Look where dividends were in 2007, and slowly over time, they decreased, all the way until just recently, where in 2024, you can see they've come up a little bit. So despite record years in sales, revenue, distribution, you have a sustained declining dividend rate. Why is that? Well, the obvious answer is interest rates. Here's a quick graph showing treasury rates over the last 20 years. And you can see where they bottomed out in 2020 and then started coming back up again in 2021. So why is that important? Let's look at interest rates, caps on IUL, and dividends together. Here is a highly rated mutual company, one of, if not the largest distributors of IUL in the marketplace, who publishes their cap history on their in-force IUL products. What is obvious by this graph is when interest rates were higher, IUL caps and dividends were higher. As interest rates came down, so did cap and dividend rates. Notice that interest rates have come back up in 2024, both on in-force IUL cap and whole life dividends have come up as well. So, does anyone not trust the New York Lifes, the Mass Mutuals, the Northwestern Mutuals of the world for paying lower dividends in a declining interest rate environment? then why do the IUL providers get such a bad rap for doing, in a sense, the exact same thing? It makes no sense to me. In a nutshell, IUL cap and participation rates, their pricing are affected by interest rates and volatility, and their history reflects that. When carriers are earning a higher interest rate in their general account, they have more money that goes into the option budget to buy higher caps. Lower interest rates means less interest, so lower caps. Then lastly is the cost of those options, which is dictated primarily by volatility. So the objection: I don't trust the insurance companies. They have a history of lowering caps and par rates. In response, how have those in-force IUL policies actually performed in the last 10 to 15 years? Let's look at some real life examples. Now, this is my personal IUL policy that I bought as a 35-year-old back in 2011. You can see back then, in what we call the wild, wild west days of IUL, my carrier projected rate was 9.51%. Nowadays, I rarely ever run anything over 6, and it's usually closer to 5.75. Despite all of that, my assumed cash value in year 12 was roughly $162,000. And you can see this was my issued illustration in 2011. Now here's my policy summary 12 years later, showing an accumulation value of $158,000. So no, I did not get to 162,000 at 9.51%, but just $3,600 short. So still earning over 9% in my IUL policy. And an asset protected against loss with the ability to earn income tax-free and provide a death benefit to my family. I personally am very happy with how my IUL is done for me and my family. Here is another example of an IUL purchased by an advisor that I work with. This is a Lincoln policy issued in 2010. For those familiar in the IUL space, you know Lincoln significantly dropped caps on their in-force IUL business. This is one of those policies. His projected interest rate back then assumed 8% with a year 13 cash value of $87,000. Here is his in-force illustration, showing a cash value of nearly $84,000. So no, he did not quite earn 8%, maybe 7.75. So still, in my opinion, really good. So what is fair and reasonable as far as interest rate assumption moving forward? I shared the IUL cap history of a highly rated mutual company going back to 2007, and their average cap over 17 years was over 12%. And that was during a sustained declining interest rate environment. I've shared real life IUL examples with historical performance in the 7.75 to 8.75% range. So again, what is fair and reasonable IUL interest rates projected moving forward? Here is 20 years of S&P performance with varying cap assumptions. I showed you a carrier's IUL history where the caps had bottomed out at about 9% during historically low interest rates. So what is fair and reasonable moving forward? Is it 10% cap, 11%, 10.5%, 12 seems too high? Is 9% fair? Let's say you are the harshest IUL critic out there, so we'll assume 9%. Under that assumption, over the last 20 years of market conditions, an IUL would have averaged 6.18%. This is stress testing IUL because we are doing our best to use fair and reasonable objective assumptions. We'll come back to the stress tested 6.18% average later. So far, we've spent a lot of time looking back. Now let's start to turn the corner and move forward. So you don't trust the IUL providers. Do you trust these institutions? Vanguard, Goldman, Morningstar, Schwab. Here's their opinion on the markets over the next 10 years. 3%, 3.8 to 5.8%. Morningstar, 5.6%. So after a multi-decade bull run, it looks like we have some volatility ahead and possibly even a recession looming. Are these opinions unfair? Are they from trustworthy institutions? Assuming that they are, what could that potentially look like? Here is a hypothetical made-up market performance over the next 10 years, averaging in that 5.5 to 5.6 range. I then compared the ups and downs of the market to IULs with varying caps. So why did I do this? I've already shown you IUL historical performance when the markets have done well in a declining interest rate environment. So here's how IUL could look if markets are doing not so well in comparison. Current IUL caps are in the 11 to 12% range. I've stress tested it down to 9%, and you can see an average return of about 6%. Notice in these volatile markets, when having your money in an asset with a floor, how that affects performance. Look at the values after 10 years. IUL does tremendously well in volatile markets. Notice the market averaged 5.58%, but an IUL with a 9% cap, because of the floor, would have averaged over 6%. So by now, you've seen that I've stress tested IUL in bull markets. I've stress tested IUL in bear markets, higher interest rate environments, lower interest rate environments, all the way down to a 9% cap. All of those assumptions, the average assumed returns are in the 6 to 8% range. Why is that important? I've shared market sentiment, opinions, forecasts from Morningstar, Schwab, Vanguard, etc., who suggested the broad markets are likely to average less than 6% over the next 10 years. To be fair and objective in our analysis, let's assume the markets far exceed those expectations and what I'll call a best case type scenario. Let's assume a managed account on a male 45 paying $20,000 a year for 20 years, who earns not 6%, but earns over 10% over the next 20 years. Then at retirement, typical rule of 100 stuff, the portfolio averages 7.77%. In this completely made up hypothetical, the client would have $50,000 a year of taxable income until age 100. Now, let's stress test an IUL, the opposite way, worst case scenario, in my opinion, but even more so. I'm sorry to keep going back to this again. Assume the markets average only 5.58%, and IUL with only a 9% cap would still have averaged over 6%. This illustration assumes an IUL averages only 5.5%. Under this stress-tested assumption, an IUL would generate $58,000 of tax-free income compared to the $50,000 of taxable income in the managed portfolio, where it averaged over 10% during the accumulation years and nearly 8% at retirement. Just think about that. How bad would the markets have to be for an IUL to only average 5.5% with a 9% cap? Now think about the illustrated income disparity in favor of the IUL, showing a managed account in very favorable conditions and the IUL in horrible conditions. Are you less likely, more likely, as likely to earn 5.5% in an IUL over the next 40 plus years, or average the assumed 10% in the managed account, despite forecasts from the Morningstars and Schwabs and Vanguards of the world? To me, it's hard to argue that a properly designed IUL should at least be considered for a portion of one's asset mix for retirement income. So, in conclusion, in my opinion, I believe 5.5 to 6% illustrated rate of return on an IUL is fair and reasonable. This takes into account or consideration the likelihood of not only reduced market performance, but also consideration for a future potential reduction in current caps and par rates. IUL competes very favorable with managed accounts in the best of times, and even more so in the worst of times. As always, if you believe any of these assumptions are unrealistic, unfair, and/or misleading, I welcome that feedback and can provide updated models or assumptions as requested. I hope you like this video on handling IUL objections. Feel free to reach out to me directly with any comments or questions. Again, this is Ken Williams with BGA Insurance.